I think it's fairly textbook in the sense that when the rotation started after Liberation Day, it was built on the premise of the interest rate cutting to continue later in the year. And people started to see after the one big beautiful bill passed, we've got the extension of tax cuts and some additional tax cuts and accelerated depreciation. So a lot of the, I guess, the backdrop for a risk on rally, so to speak, and a bit of a rotation. And,
Right.
large cap tech had been so great for so long and was getting rather expensive. So the ability to find companies that were going to have some tailwinds for
Right.
earnings, but at cheaper valuations was pretty textbook.
Given the tech shock of the last week, you're out of nuclear engineering, Texas A&M, which is one of the most famous programs in the country on this. You studied a lot of dynamics and almost the Newtonian plumbing of a given science system. Are our markets acting normal right now?
I don't know that if they ever act normal, but I think so. As an engineer, it's you're trying to take scientific principles, but then apply them in real life. And I think that's similar to investing. I mean, we have investing theory that is well founded, but it's not like physics. It's not, there is no E equals MC squared. And so you've got the human behavioral elements to take into account. So it's investing is more like an engineering application.
So, John, we're in a market here, where earnings really do matter here. We've got a Fed that is cutting rates, but the focus now is kind of reshifted back to earnings here. What have you seen so far in this earnings cycle, and is it enough to support this market going forward, do you think?
I've found this earnings season to be very interesting because we came into it with consensus expectations for the S&P for earnings growth for maybe 7-ish%, something like that. But the reality is earnings growth has been about 13%. So that's a significant beat. I mean, we normally expect the bar to be set low enough for most companies to beat it. But with that said, that was a pretty significant upside surprise, but yet it hasn't been enough to move the market. I mean, the S&P is basically flat. So that just tells me that expectations had gotten really high and, price for perfection maybe, but at least price for a lot of good things to happen.
We continue with Allspring's John Campbell, Senior Portfolio Manager. This morning is a nice lift to the market. Post State of the Union, some good voices coming up. Zach Cohen on deck here out of Washington. Paul Sweeney with John Campbell.
Hey, John, what screens well for you guys right now? Is it a certain industry? Is it a certain investment factor that screens well for you? What are you guys looking at these days?
Yeah, it's a great question. So our team is a systematic equity team. So we are quantitatively oriented, and we focus on value, quality, and momentum. A lot of different measurements of value, quality, and momentum. But we are seeing that value is perking up quite a bit, and you can see that just in the indices where Russell 1 value outperforming Russell 1 growth. But we see it also in just typical valuation factors. What is not working right now, which has been working for a while, are factors like growth, high sales growth. Momentum is working, although it's not as strong as it had been last year because we're seeing some of these reversals under the surface. So value, smaller cap are some of the factors that are working.